Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within corporate filings. And no, this one is not about a struggling candy company, although the numbers might make you wish for a sugar rush wink. Today we're diving deep into Energy Fuels Incorporated's latest 10K report. And trust me, it is packed with more twists and turns than a mountain road. Before we jump in, if you love getting unfiltered insights from these financial documents, make sure you are subscribed. And for even more exclusive content and discussions, join our Discord, the link is in the description below. Alright, let's get straight to it. Energy Fuels, a company that is really trying to make its mark in critical minerals, is showing some interesting shifts. Looking at their financials for the 31st of December 2025, a few numbers immediately pop out. First, their total assets jumped significantly to over $1.4 billion. That is a huge leap from about $612 million the year before. What fueled this massive growth? Well, it seems like they issued a whopping $700 million in convertible senior notes. That is a massive chunk of debt, and while it can fund growth, it also comes with a hefty price tag. They also saw a big increase in their current assets, mainly driven by their marketable securities, which shot up from around $80 million to almost $800 million. It looks like they're parking a lot of cash in investments, which is a pretty solid move, especially with that new debt on their books. But how is the actual business doing? Well, revenues took a bit of a hit, dropping by about $12 million or 16% to just under $66 million. This dip is mostly because their heavy mineral sand sales are way down. That is because mining at their Cadwell project in Kenya wrapped up, and they're now just selling off remaining inventory. On the flip side, their uranium sales actually went up more volume, but at a lower price per pound, which is a mixed bag. Unfortunately, their costs didn't quite follow revenues down. Costs applicable to uranium concentrates shot up by $14 million per pound, a whopping 38% increase as they sold more. And those heavy mineral sands costs, they went up by over $300 per ton, a 55% jump even as sales volumes plummeted. That definitely squeezes their profit margins. They're also spending a lot more on future growth, with exploration and development costs skyrocketing by 168% to over $38 million. This is largely due to their big bets on new projects like the Juniper Zone at the Pinyon Plain project and their expanding rare earth element initiatives. Plus, they've got some non-recurring charges like writing off value, added tax receivables, and abandoning an investment, which adds to these expenses. All this spending combined with lower revenues led to a much bigger operating loss. It more than doubled to over $101 million. And when you add in a significant loss in unconsolidated affiliates, their net loss is nearing $86 million. That is a tough pill to swallow, especially compared to their profitable year in 2023. Looking at the bottom line, they've swung from a profit of almost $100 million just 2 years ago to a loss of $86 million in 2025. That is a massive swing, and it really highlights the challenges they're facing, especially with those soaring costs and declining heavy mineral sands revenue. Now about that debt, that $700 million convertible note means they've got a lot of future obligations. They've also got these capped call transactions, which are meant to limit dilution from converting those notes, but they cost a pretty penny, over $53 million. It seems like they are going all in on expanding their rare earth business and other projects. The company did issue a lot more shares to raise cash, over 40 million shares for about $272 million via their at-the-market program. This definitely helps with liquidity, but also dilutes existing shareholders. And where did all that cash go? Well, a huge chunk, almost $800 million, is tied up in marketable securities. They're playing it safe by investing in government notes and agencies, which is smart, but it also means that cash isn't directly fueling immediate operations or projects. Now, onto something a bit heavy, asset retirement obligations. They've got over $50 million set aside for future reclamation, and that number is projected to grow. This is a legal requirement, but it is a significant financial commitment hanging over their heads. So, to sum up the balance sheet, they've got more assets than ever, largely thanks to that debt and those investments, but their liabilities have also ballooned. This is a company making a play for the future, but it is a high-stakes bet. Let's break down those segment performances. The uranium segment actually saw revenues increase by about $10 million. That is thanks to selling more uranium even at a slightly lower price. They sold more on the spot market, which can be good for short-term gains, but also exposes them to price volatility. The heavy mineral sands segment, however, took a huge hit, with revenues dropping by $24 million. That is because the Cadwell mine is done, and they're just left with old inventory to sell. This segment is essentially winding down. And what about rare earth elements? Well, for now, there is no revenue reported for this segment. They're investing heavily, building out their separation circuits, but the big money from selling separated rare earths is likely still down the road. Looking at the consolidated results, their operating loss nearly doubled from the previous year, climbing to over $101 million. This is driven by those soaring exploration and development costs, plus higher selling, general, and administrative expenses, likely due to expanding their team, especially after acquiring base resources. That increased headcount is a big driver here. Energy Fuels operates in some pretty volatile markets. Uranium prices have seen some ups and downs, but the company sees a positive long-term future driven by decarbonization goals and energy security. They've got some solid long-term contracts which provides a nice base, but they're also looking to sell more on the spot market. The rare earth market is even more interesting. With China dominating production, Energy Fuels is aiming to carve out a significant ex-China supply chain, a move that could be hugely profitable if they succeed. Risks abound though, from government regulations on mining to the complexities of international operations, especially in places like Madagascar and Brazil. And then there is the potential nuclear accident concerns that could impact public perception of nuclear energy. A huge move for them is the planned acquisition of Australian Strategic Materials, or ASM, a company that produces rare earth metals and alloys. If this deal goes through, Energy Fuels claims they'll become the largest fully integrated rare earth producer outside of China. That is a bold claim, and if they can pull it off, it could be a game changer for them and for global supply chains. However, it is a massive undertaking and depends on shareholder and regulatory approvals. Now, let's talk about those financials. Their revenue has been a bit of a roller coaster. In 2023, they were actually profitable, but in 2024 and 2025, they've seen significant losses. In 2025, the net loss widened to $86 million, a huge jump from a loss of $47 million in 2024. This is largely due to big increases in operating costs, especially those exploration and development expenses, and absorbing the expenses from acquiring base resources. Those heavy mineral sand revenues have dried up as expected, and the rare earth segment isn't generating cash yet. That $700 million debt is a heavy burden. While it provides a huge cash injection right now, the interest payments and potential conversion down the line are going to impact their future financials. They're betting big on these new ventures, especially the rare earths, to eventually justify this debt. The auditors, KPMG, seem to think the financials are presented fairly and internal controls are effective. That is a plus, but they did flag the asset retirement obligation costs as a critical audit matter. This suggests that estimating those future reclamation costs is tricky, and even small changes in assumptions for decommissioning could have a big financial impact. Overall, Energy Fuels is in an interesting spot. They're making a massive pivot towards critical minerals and rare earths, a sector with huge long-term potential, especially given geopolitical shifts and the push for green technologies. They've secured significant funding and are making bold moves with acquisitions and project development. However, the financial risks are undeniable. That massive debt load, the reliance on future market prices for their commodities, and the sheer complexity of developing these large-scale international projects, especially with the political uncertainties in places like Madagascar, are all serious considerations. They're essentially betting the farm on rare earths and uranium demand soaring and their strategic decisions paying off. Whether this bold strategy translates into long-term profitability remains to be seen. It is a high-risk, high-reward play, and investors will be watching closely. Alright, that is our deep dive into Energy Fuels' latest filings. What is your take on their strategy and those financials? Do you think they're on the right track or taking on too much risk? Let me know your thoughts in the comments below. If this deep dive was valuable, hitting that like button really helps, and subscribe for more corporate breakdowns, and don't forget to jump into our Discord community. Linked in the description for even more insights. Thanks for watching, see you next time.